Hey everybody, welcome back to the Market Interest, where we talk stocks, finance, and the markets. This has been a pretty tough year for investors. Obviously, as we all know, the market has been really getting a beat down. I don't expect it to recover as quickly or as smoothly as we have experienced in 2020. That was a really quick recovery. I think it's going to be a lot more volatile than usual. As you know, the S&P 500, it's down 18% so far year to date. The Dow is down 14% year to date. NASDAQ is down over 27% year to date, and the Russell 2000 is down 21% year to date. So really, why is all this happening? It doesn't seem to make sense. The economy is doing well. We have, really good unemployment numbers, extremely low unemployment numbers, job signs, hiring now, signs are up everywhere you turn, and wages are increasing. People are getting paid more now than they ever have. With all these positive economic factors, people are just wondering, hey, what's going on? Like, why are we experiencing such a downturn in the market? So what I want to do is break down some of the reasons why we're seeing a strong market crash right now, explain why the market is crashing right now, and what can you guys do to defend against some of the crash. Just diversify a little bit more and start hedging your bets in different ways. Don't forget, if you want to stay up to date with the latest market news and stock information, don't forget to subscribe to the channel and also go long on that like button. Really appreciate it, guys. All right, so let's start first with why I'm really not too overly concerned with the market being down where it is right now. This graph here shows the annual returns for the S&P 500 and their intra-year declines, the furthest they've declined within the year. We're always going to have some type of downturn in the market, some negative returns. About 10%, 10 to 12% is going to be average downturn in the market. So we're in that area a little bit further, I would say, than typical, but still not anything I'm overly concerned about because, we know it's going to come back at some point eventually. No guarantees, all the disclosures, blah, blah, blah. I just wanted to share this right off the bat and say, hey, if you guys are holding onto your positions, good for you. Just because the market's down doesn't mean you should be selling off or getting worried. It usually is a good time to buy when you're seeing some downturns. It's all about where are you going to buy right now, especially. Why is the market going down? Well, forward price to earnings multiples are really a good way of gauging the value of a stock. In recent history, the PE ratio was just through the roof. It didn't make any sense. Things were just flying high, really, really high. I was seeing tech companies that had like multiples of over 100, 200, like things that didn't make sense. Recently, we started to see a decline because prices are dropping. And then earnings are actually going up with a handful of these companies. There's actually some really good earnings reports that have come out. Not all of them, but a good chunk of them are decent. So earnings have been going up and prices have been dropping. Now, the 25-year average forward price to earnings multiple is going to be about 16 to 17. And we have been seeing multiples that were well above 20, which is over one standard deviation for all you nerds out there, above the average. Now we're starting to see multiples drop down. When multiples are really high, that's saying the stock is expensive. It's saying things are mispriced. They can't stay elevated at that level for a long period of time. And money managers know that, smart investors know that. And so I think that's what we've started to see here is a lot of people, a lot of companies, big money managers, they're starting to shift from especially growth-oriented companies taking their winnings off the table, and we're starting to see the prices drop. Reason number two why I really think we're seeing the market drop is because a lot of money managers are shifting their money. And I know this personally because I get a lot of market updates or reports. I'll go over one of them here. I'm not going over the company specifically, but just showing that there's been a really big change in terms of how they're allocating their portfolios. And they're moving a lot of money from growth into value. There's just a really big shift from growth into value. And this is not a small company. This is a very, very large institution. We're talking about billions of dollars under management. So when they make small changes in their portfolios, it's going to have a very large effect in terms of what's happening in the market. These guys can move markets. Almost all their model portfolios, they're decreasing the amount of U.S. large cap growth companies. So a lot of these are S&P 500 oriented or tech oriented companies. Now, instead, they're increasing their allocation to U.S. large cap value equity stocks instead. So another reason why we're seeing a shift in prices or the markets, being so volatile and really going down, the market crashing, 1 week we'll have it crash, the next day it's going up. And we're seeing companies, big institutions start to recalibrate and reallocate their assets from growth into more of a value-oriented position, which I think is pretty interesting to see this happen in real time. It's something that I've been saying here on the channel for a while, is that we really need to start focusing more on value-oriented companies instead of just growth-oriented companies, because one, the math just doesn't make sense for it to be where those valuations are, but two, these institutions are making moves now. And it's not something where they make one change overnight and then they're done. This is something that happens strategically over time. A lot of these growth stocks are built within the S&P 500. We're talking about Apple, Facebook, Google, Amazon, Nvidia. Big tech names are all built within a lot of these other indexes. And the overall market, we know that just a handful of companies, actually I'll pull it up right now, just a handful of companies, weight of the top 10 stocks in the S&P 500 equals about 30%, 30% of the S&P index. So there's just 10 companies controlling 30% of the index, which is massive. So when you get a large institution that's making just a small change to an allocation from growth-oriented companies that's controlling 30% of an index, and now moving it into a value company instead that's not in the index or potentially not in the index, that's going to have really big impacts on the S&P 500 and the index, any of the other indexes that track them. So these allocations from these big money managers shifting from growth into value is going to have a really big cascading effect on the overall markets and a lot of people's portfolios. So just another reason why we're seeing so much volatility and movements in the markets right now. Now, the third reason we're seeing such a big decline in markets and so much volatility in markets is really the elephant in the room, is interest rates are going up. There's inflation that's here, interest rates are going up, and that's going to have a cascading effect on the market as well. If we take a peek at the consumer price index over the past 10 years, we really see that there's a drastic increase. Obviously, we want to have some type of growth. It's okay to have minimal inflation, but now we're getting to a point where if CPI has gone up 10, 20%, it's a lot within a short period of time. I'm going to get into some boring stuff right here, guys, so try to stick with me if you can. I'm going to break it down pretty as simple as possible. But when inflation increases, then the Feds need to raise interest rates. And when the Fed raises interest rates, then it's going to affect how people value stocks or companies value stocks. One way of valuing a stock is with the dividend discount model. This is the basic dividend discount model. Every D that you see is a dividend. Think of that as a dividend payment at some point in the future time. So people will value a stock based on all those dividends being added up together over time and giving a price of a company. That's what the price of a stock should be at this point in time, based on a handful of assumptions. Now, here's where it gets tricky with interest rates, guys. The R at the bottom of this formula here, interest rates have an effect on that R, which is your required rate of return, right? So if you think of interest rates going up over time, think of R going up over time. That R is increasing every single year. If the denominator is increasing, that means the value, P0, is going to be shrinking. That means the ending value is going to shrink. So what's happening here is we're seeing interest rates, or companies are valuing stocks saying, hey, we think interest rates are going to be going up over time for X amount of years. And they weren't planning on that price. They weren't planning on interest rates going up over the next 5 years as much as it really is. But because inflation's here, the Feds have to raise interest rates. And because the Fed has to raise interest rates, that's affecting R. That's affecting the bottom line here, guys. And now the bottom line is affecting the reverse engineering, the math, just pretty much discounting all those future dividends back to today, which is making the value of the stock lower. Just to break it down in a mathematical formula, I know it's kind of boring and confusing, but that's really what it comes down to, guys, is if interest rates are going up, that means it's going to affect the mathematical formula that people and analysts are using to determine what a value of a stock is. And that's not good. And I think really the reason why we're seeing so much volatility happen right now is because there isn't just a clear idea in terms of how the Fed is going to land with interest rates. They say they're going to raise it 0.5% for the next few meetings, but are they actually going to do that? It seems like the bond market is pricing something different, thinks that it has to increase rates even faster. So that's a little tricky. It's going to be pretty difficult for all these different companies, all these different analysts to fall back on the same assumptions. Everybody's going to have a different assumption in terms of what R is at the bottom and what the rates are going to be in the future. Everybody has a different assumption about this. So that's why we're seeing so much volatility. There's too much confusion. People don't know where to turn, or analysts don't know where to allocate money necessarily. So it's a tricky environment to be in. So the question is, what do we do? What do we actually get down to? What can we do to defend against inflation, these market rate movements? Well, I've been pitching on this channel for like the entire year that there's energy and commodities are a really good place to be parking money for the time being. And I just want to go over what the year-to-date performance is of, well, really pretty much anything you can think of here. As you can see, Brent oil is up 45% year-to-date. Commodities up 32% year-to-date. So these two are really primed areas. When we're talking about inflation, these are good areas to kind of lean back on for the time being. It's not something you'd want to just buy and hold forever, not necessarily buy and hold forever. I've personally been overweighting my portfolios, my clients' portfolios into more energy and commodities right now because they generally have a good return during inflationary environments. Also, there's some REITs, and I'm a little confused in terms of why this is such a negative number right now. There's some REITs that I think are actually a good place to be, but it looks like the overall asset class of REITs aren't doing too hot. But generally, with a strong economy and inflationary environment, real estate is actually a good place to be. But right now, we're seeing REITs, they're down almost 18% year to date. So not something I would play around with unless you're doing a lot of due diligence and research beforehand, getting into the right areas of that market. But you can see here, again, we're looking at Brent oil and commodities that are really the two that are doing really well. So yeah, you have to be a little bit more selective in the market. If you're not really sure what you should be investing in, or like which asset class you should be leaning towards, or starting to diversify away from, then feel free to click the link in the description down below. We can have a one-on-one consultation, free consultation, and just go over your portfolio, your investment strategy, and find out if any other investments make sense for you, or if there's a better allocation that would make sense for you. So feel free to check that out. So if you guys have been following my channel at all, you know that I've been really saying energy stocks are really the place to be, probably for the past 3-4 months now. Really, energy has been undervalued for a long period of time now, and I think it's a really nice prime spot to be hanging out. So I've allocated a large portion, mostly larger cap value stocks, but there's some small mid cap value stocks that are really, really nice. Now you got to be, keep in mind that there's going to be a little bit more volatility inherent with those types of stocks, even with commodities as well. There's going to be more volatility with it, but their beta is a little bit higher, so they're going to be bumping around a lot more. But if you're holding them for a nice period, there's going to be there should be some pretty good returns as long as things continue the way that they currently are. So yeah, if you have any questions about any of this, again, feel free, click the link in the description down below. We can set up a one-on-one consultation, talk about it, see if it makes sense for you. But yeah, if you want to stay up to date in terms of other stocks that I think are most appropriate for this time, ones that I'm investing in personally, then again, don't forget to subscribe to the channel. I fill up a new video at least once a week, with different companies that I think are appropriate for the time being, that are undervalued, and have a good position moving forward. And then don't forget to hit the like button. Really appreciate that. Helps out the channel. Yeah. All right. Look forward to seeing you guys next week. Take care.